everyone, and welcome to the Financial Empowerment Network virtual learning series. The Financial Empowerment Network envisions communities where low and moderate income individuals and families can achieve financial well-being. Our mission is to advance financial empowerment through partnerships that support access to affordable, effective, and relevant services, products, and other resources. Our process is to serve as a liaison and broker to create connections, disseminate evidence-based and promising practices, and bring resources to a network of providers to integrate financial empowerment into other services, including anti-poverty strategies. Our webinar today is on debt management, credit reports, and scores. The webinar purpose is to offer an overview of debt management resources, credit strategies, and an understanding of the new 2020 credit score formula. The webinar will also focus on debt management resources to assist you with clients who are impacted by temporary layoffs and quarantine due to COVID-19. The webinar audience is intended for professionals in the field whom we define as case managers, advocates, and financial counselors, coaches to guide and contextualize the needs of your clients. Our trainer today is Becky House, Education, Housing, and Communications Director with American Financial Solutions. Becky is also a board director for the Financial Empowerment Network and is our Banco in Washington co-chair. Becky has 24 years of experience in training and education development in nonprofit organizations. She is certified as a financial educator through the National Foundation for Credit Counseling and was named their 2000 Financial Educator of the Year. Becky is also an expert advisor for media outlets such as U.S. News and World Report and ABC, CBS, and Money Magazine. Thank you, Becky, for taking time to facilitate this training today. And again, I want to thank everyone for joining us.
Thank you, Alice. As Alice said, my name is Becky House, and I work for American Financial Solutions. We are a division of North Seattle Community College Foundation, and this is part of what we do. We teach financial education classes, and we also work with people one-on-one on all types of personal finance topics like budgeting, credit, debt management, bankruptcy, housing if people are looking or trying to avoid foreclosure or are facing foreclosure or looking to purchase a home, student loans, all kinds of personal finance topics. And I wanted to just point out this picture on the front that you see here, the birdhouse, was from one of our clients who had decided that it was time for her to get out of debt. And she took all of her credit cards, she cut them all up and made them into a little birdhouse. And so I always thought this was a really cool picture and thought I'd share that with you today. We have a lot of things to cover today, and I'm going to try to make sure we get to all of it. Alice is going to try to field the questions. If you have questions, you can put those into chat. We're going to talk about accessing credit reports, which is really important right now. Understanding credit, disputing information in a credit report. We're going to talk about the credit scores, as Alice said, the changes in those, what influences those credit scores, and then some options for handling debt, whether it's debt collections, credit cards, mortgages, whatever kind of situation people are facing. And then we'll also take a few minutes to look at building credit, rebuilding credit, and even just trying to stabilize credit, especially right now with what we're experiencing. So the first thing I think most of us are probably familiar with are the three national credit reporting agencies. There are a lot of other businesses or organizations that qualify as credit reporting agencies, but these are the main three that we always talk about in the financial community: Equifax, Experian, and TransUnion. Right now, it's probably a terrific time for people to get copies of their credit reports, especially if someone is facing a layoff or a reduction in hours or just an overall job loss. It's good to find out where you are exactly on your credit so you have a snapshot of where you are as we head into this, and you'll have something to compare that to as we come out the other side, and make sure that everything that is getting reported accurately. So through annualcreditreport.com, as you see here on your screen, everybody's entitled to a free copy of their credit report from each one of those three major credit bureaus every 12 months, and that's a rolling 12-month period. So, you know, if you pulled them all today, you could pull them all three again next year, same time. People talk a lot about staggering their credit reports, so pulling one now, pulling one, you know, in 4 months, and pulling the last one in another 4 months, and then repeating that cycle. I think that's a great strategy if you're very familiar with the information that's in your credit report. Otherwise, I would suggest that people pull them all three today, because the information that's in those credit reports may not be the same across credit reports. Not all creditors report to all major credit reporting agencies. And you want to have a good, again, a good baseline of what's showing up on each credit report at this point in time. There's a lot of sites out there nowadays where people can get a free copy of their credit report. So it's not just annualcreditreport.com. And a lot of these sites also do come with a credit score. Annualcreditreport.com does not come with a credit score. So let's say you log into that site, you get a copy of your credit report. Maybe you start with TransUnion. You can add a score on, and that usually costs anywhere from $7 to $10. They'll also probably try to offer, you know, other services that, you know, they want you to buy, but you don't have to do that. You can get the report for free. But again, these other sites that popped up here are sites that typically do offer a score with that, and we'll talk a lot about how those scoring models work. But just understand that that might not be a score that a lender is going to see. You know, if you go apply for a mortgage or a car loan or even a credit card, it might be something completely different. The other thing to understand about those sites is that they're sales generating sites. So, you know, they're going to show you other services and other offers that you might qualify for, or you might, you know, feel like partaking in, but they might not be the best for you in that situation. Their goal is to generate income for them and their partners. So just another thing to think about when you're using other sites. Annualcreditreport.com, once you get into getting your credit reports, it does become more sales generated, because you go in from annualcreditreport.com to Experian, to TransUnion, to Equifax. And like I said, once you get into those sites, they start adding on the other services that you might want to buy. You can ignore that and just get the actual free credit report, or you can decide you want those services too. Okay. When we're looking at those credit reports, we have a kind of a sample credit report here. And I like to show what that looks like. So when we have a credit report, you know, you have these different sections. The first section is your personal information. And on that, you're going to have your name, your social security number, the address that you live at now, currently, potentially, if that's been reported to the credit reporting agencies. Typically, you will not see, like this shows March 15th, 1972 for a date of birth, but you will see like 1972. So it won't give the exact date of birth. Maybe previous addresses that you've lived at. Sometimes you'll see employment information listed on there. The thing about that personal information in a credit report, it is the only section of a credit report that you cannot dispute online. Typically, if you have to dispute anything that is your identifying information, so again, your name, your zip, or not your zip, but your address, your social security number, date of birth, anything like that, that's going to have to be disputed through the mail, or you can also call to verify your identity and dispute that information. Even when you call, though, they may ask you to send in something to show that, like a driver's license or a rental agreement or something if it's an address that you're trying to update. Everything else, though, if you've pulled that credit report online or you pulled that credit report within the last 90 days, you can dispute it online, or you can dispute it over the telephone, which again, we'll talk a little bit more about disputing here. But I just wanted to let you know that about the personal information has to be disputed in writing. So again, when we look at a credit report, if you look down at D, the credit account information, that is the information that probably has it definitely does have the biggest impact on somebody's credit score. So this is the information, this is, I owe this car dealership this amount of money. Do I make my payments on time every time? If you look down that line to line 10, you can see where it shows this is past due $150. So that's definitely something we don't want to see. You can also see down at the bottom of section D where it says previous payment history, 2 times this person was 30 days late, 3 times they were 60 days late. So all of those are going to be negatively impacting a credit score. So that's what you're looking at on that credit account information. Does the person pay their bills on time every time? So that's what we're looking for. You have to be at least 30 days late, technically 31 days late, in order for a creditor to report you or to report someone as past due. So in times like this, when we're looking at that, that is something to consider. If you can make a payment or get a payment in before that 31st day, it's not going to show up on your credit report. And that's not always possible, but certainly if it's possible, get that done and save the credit. The other thing about that, we have that just above that in section C, collection account information. We're going to talk a lot more about collections in just a little bit, but this is going to show us, when did this account go past due? What was it for? How much is owed? Is it paid or is it unpaid? And again, that's part of that credit history. So the biggest chunk of a credit score is, again, do we pay our bills on time? So both C and D are going to be impacting that. And then we look at B, which is public record information. Mostly what we see nowadays in public record is bankruptcy. Bankruptcy is the only thing that is negative on a credit report that can stay past the 7-year time limit. So bankruptcy can stay on a credit report for up to 10 years from the date that the bankruptcy is filed. Anything else that is negative can only stay on that credit report for 7 years. Technically, it's 7.5 years from the time that the account goes past due. So when we're talking about collections, it's not from the time that the account goes to collection. It's from the time that the account went past due with the original creditor. So if I had a collection account with, let's say, Comcast cable, no offense to Comcast, just using it as an example. But let's say I had an account with Comcast, I wasn't able to pay it. Comcast is going to, they're going to try for a few months to get me to pay that bill. And if they can't, it's going to end up going to collections. So at that point in time, the first time that I missed that payment to Comcast and never made another payment, that's when the clock starts ticking. So let's say 6 months later, they sell it to a collection agency. Now, that collection agency has to give me 30 days notice before they put it on my credit report. So they're going to give me notice. So now another 30 days is going by. So now we're at 7 months before it even hits my credit report. Hopefully this makes sense. So that clock has already been ticking for 7 months, that clock of 7 years. So we only have 6 years and 3 months left for this item to that Comcast account to show as a collection account on our credit report. And again, hopefully that makes sense. And then if we look down at E, we're looking at companies that have looked at our credit report. This is also part of a score, not a huge chunk of the score, but it does matter for a credit score. So the inquiries, who is looking at your credit report? There's a lot of inquiries that really don't matter. So for ourselves, when I pull my credit report from annualcreditreport.com, that does not count against me because I'm not offering myself credit. I'm not applying for credit. If I get my credit report from Credit Karma or Quizzle or Credit Sesame or any of those, that doesn't count because again, I'm not offering myself credit. I'm just looking at my credit report and that's okay for us to do. If I apply for a credit card, that's an actual inquiry that would potentially count against my score. If I apply for a mortgage, that's a potential inquiry that will count against my score. Car loans are the same thing. Now, those are different. Mortgages and car loans, I have a window of time to shop for the best rates on those types of accounts, and they will only impact me as one inquiry. So I might go to 5 different mortgage lenders and apply for a mortgage to see who's going to give me the best, rates and fees, but and they will all show up on my credit report, but they will only count as one as long as I do them within a certain window of time. And that window of time depends on the credit score, but I typically say anywhere from 14 to 45 days. Um, Other things that don't count, like employment checks, those do not count against a credit report or a credit score. They will show on a credit report. Some rental inquiries, so if someone's applying to rent a house or an apartment, some count and some do not. And I honestly cannot give you the exact reason why that is. It really seems to depend on the mechanism that is used for pulling that credit report. But it is something that I think should be addressed, but whatever the case, that's how it works. Um, uh, in anything, like I said, if it's a store card or like a, Kohl's or JCPenney's or something like that, or a regular credit card, that's definitely going to be a hard inquiry on a credit report too and count against that score. Okay. So if you're looking at that credit report, or you have someone who's looking at their credit report, and there are errors in a credit report, which are very common. I'm sure many of you have heard the statistics that 1 in 4 of us has a error on our credit report that is significant enough to impact our ability to get a job or impact our ability to obtain a loan. So the first thing is to contact the credit bureaus. And this is where sometimes people will get off track. They'll go straight to the creditor themselves. You really want to go directly to the credit bureau to make that dispute if it's showing up in your credit bureau. You're enacting the Fair Credit Reporting Act when you do that. So you contact the credit bureau. Again, if you pulled your credit reports online, you can dispute it online, or you can also telephone and dispute those whatever the miscellaneous information is that's not correct on there as well. So if you do it online, you can actually upload documentation now. If you have receipts, or if you have a letter from a creditor, or if you write your own letter, you can also attach that and upload that to the file to explain, why something is not correct. Any kind of supporting documentation you have, that's what you want to upload or provide to the credit reporting agencies. Now, if you have that kind of information and you cannot upload it, then really the only option is to be able to send it through the mail. Otherwise, they're not going to be able to receive that, obviously, over the telephone. I would say that what the way the process works, you contact the credit bureaus, and then the credit bureau is going to contact the actual creditor. So whoever listed that information on the credit report, that creditor is going to get back to the credit bureaus, who then comes back to you, the consumer, and says, this is what's going to happen with the account. That entire process is supposed to take 30 days or less. When you do the dispute online, it usually is very quick. If they come back and they say, yep, it's wrong and we're going to correct it, that's great. That's absolutely fantastic. If they come back and they say, nope, it's right, we're going to leave it as it is, you do have another process. They could come back and say, hey, we need another, and this is the creditor coming back. They could come back to the credit bureau and say, we need an additional time to investigate what's going on. They can have that additional time up to a maximum of 30 days. So potentially they have 60 days to investigate that claim. That usually does not happen though. So if they do come back and they say that, yes, that information is accurate and we're going to leave it on the credit report, the next step, if you believe that that's not accurate and it shouldn't be on there, is to file a statement with the credit bureaus that explains why you disagree with that. It's limited. You only have 100 words, which is not a lot, but it is definitely something that you want to do. The statement, anyone who pulls your credit report is going to see that statement on there that explains why this is there. It doesn't change the credit report. It doesn't change the technical reporting of it, the item, but it does show someone that, hey, this person's paying attention. they are, trying to work on their credit. And there's obviously some kind of a discrepancy with this creditor. You can also report the Bureau and the creditor's failure to correct an error to the Consumer Financial Protection Bureau and the Federal Trade Commission. Now, neither one of these agencies are going to technically do anything specifically for you. The Federal Trade Commission, though, does collect complaints. They look for trends. And when they see those trends, that's when they will try to go after the faulty players. And we've seen a lot of action come against collection agencies over the last few years, which has been really helpful. And it also has made some changes in how things happen when it comes to credit reports. The Consumer Financial Protection Bureau could potentially contact the creditor and the credit bureau to say, hey, this person's having difficulty. And is, just as a heads up, we're letting you know this is going on, which sometimes we do see that push a creditor or a credit bureau to actually do something, to take another look at the file. So there is a possibility that contacting the Consumer Financial Protection Bureau will be the next step in helping to resolve something that's on a credit report that you believe is an error and should not be there. Okay, so we're going to talk about credit reports, and we're going to talk about credit scores, including the new credit scoring model. And the first thing I want to talk about is really the way that credit reports and scores work together, but they're two separate products. And I think sometimes this is where their confusion sets in for a lot of people, for a lot of consumers, a lot of people we work with out there. So I always have my Equifax and my Experian and my TransUnion credit report, as long as I have, something credit-based to be reported in there. If I'm somebody who's 18, I've never had credit, then yeah, I might not even have a credit report. But I have a credit report with Equifax, Experian, and TransUnion. Those do not have scores associated with them. It's just the general black and white information, how many accounts have I had, where have I lived, how much do I owe, that information. When someone is evaluating me to be able to buy a car or buy a house or open a credit card or get a bank account or something like that, they're going to use a consumer risk model that's going to sit over the top of that report, read that information and spit out a score and tell me, okay, how likely is it that this person is going to pay their bills on time? So you take the credit report, that risk model, put it over the top, and that gives you the credit score. I want to take a look at kind of what we see in our industry, when people are looking at their credit score. So this is two of the major credit scoring models that we see out there nowadays. And I say that major, FICO is a major credit scoring model. FICO is used in 90% of all lending in the United States. Almost all mortgages are done using a FICO credit score. The Vantage score is more, at this point, a consumer score. So it is a score that they are providing to us. When we go to a site like Credit Karma, that's the score that we see. We see that Vantage score, and they're not necessarily comparable. They look very similar, as you can see from this example. They both go from 300 as the lowest score to 850 as the highest score. The FICO score has got a little bit wider of a spread, in the excellent range when you look at 740 to 850, the Vantage 750 to 850. And this is a Vantage 3.0 and a FICO 8 score that we are looking at here, which we'll talk about in just a minute. But the thing is, when it plays out on a person, it looks very different. So this is an actual client who came into our office who had their information from Credit Karma. So they had their two Vantage scores, which were, you can see there, TransUnion. These are the two scores and the two credit reports you can get from Credit Karma. So their Vantage scores 624 and 613 in the very poor range. When we pulled their credit reports, their FICO scores were 712 and 706. So that's in the good range. So very different, and hopefully that makes sense. But they're measuring different things, and that's what's really critical to understand about credit scores, especially when you're looking at these other sites that are built for consumers. Where is that score coming from, and what does it actually mean? So we're going to take a look at a couple of the variances here in credit scores. What you see on your screen are just some of the credit scores that are out there. These are not all of the credit scoring models, but I wanted to show, this is what we see, and this is why it can be so confusing for consumers. So when you look at this chart, on the right-hand side, we have the FICO information, a bunch of different FICO scores. So you can see the FICO 2, 4, and 5 are mostly used in mortgage lending. All three of those scores are used in mortgage lending. And then we have a FICO 8. FICO 8 right now is the credit score that is used by almost all of the lenders who are using a FICO score. That's the score. It's very, as it says here, it's very sensitive to credit card usage. So do we keep our balances low on credit cards, or do we have high balances on credit cards? Do we have, lots of credit cards? Do we just have a couple of credit cards? I mean, they're really honing in on how we use our credit cards. The FICO 8 also ignores collections that have balances, original balances of less than $100. And that's important because we've all probably seen people with collections who have gone, maybe the collection started at $100 and now this person owes $500. So as long as it began under $100, then it will ignore that balance on a credit report. FICO 9, we heard a lot about a few years ago because they came out and they said it's, if you have medical debt, it's really going to discount that kind of a debt on a credit report. It's not going to hit people as hard. But unfortunately, a lot of lenders do not use, most lenders do not use a FICO 9 credit report or credit scoring model. And well, I'll get into that in just a minute. But so then we look at FICO 10. So these are what are coming out this summer. And this is what we keep hearing a lot about, the FICO 10 and the FICO 10T. So they're calling this the FICO 10 suite is what it is. The FICO 10 is poised to really, really fine tune how they discern we use our credit as far as credit cards and personal loans. So if you are taking out a debt consolidation loan to pay off credit cards, that's probably going to cause a score to drop. They're looking at that as more risky behavior. They're also looking at, then the 10T, that they're looking at a trend. So over the last 24 months, what has this person done as far as their debt goes? Is their debt getting higher or is their debt getting lower? So if the debt's increasing, especially, again, the focus is really on credit cards and personal loans. So if your debt is increasing on credit cards or it's increasing on personal loans, that's definitely going to have a negative impact on a FICO 10 or a FICO, well, on a FICO 10T for sure. And again, those personal loans on the FICO 10 are going to have a negative impact. The other thing with the FICO 10 is that it's going to, if you have recent late payments on here, so we're talking in the last 12 months, it's going to have a more negative impact on the score as well. Right now on the FICO 8, the farther that you get away from those late payments, the less of an impact it is. If you take a FICO 8 score right now, let's say your FICO 8 score is 660. And in the summer, when this new FICO 10 comes out, it gets applied to the same account. That score is probably going to drop down maybe even 20 points to a 640 because of the late payments that were already on the credit report. And hopefully that makes sense. I can't exactly ask you right now because we're in a webinar. So it's really important to understand, like I said, personal loans and how you're using credit. The idea is that they don't want to see a lot of personal loan expansion. So getting more personal loans, more debt that way, clearing credit cards, and then potentially running credit cards back up. So you're increasing the amount of debt that you have. That's definitely a negative and going to really impact that score. When we look at a Vantage score, Vantage on the other side, the left side, 3.0, paid collections don't count in a score. That's not true for a FICO score. Paid collections do have an impact on a score. They have less of an impact, but they do have an impact. In a Vantage 4.8, a Vantage 4.8 does a lot, the same thing really as a FICO 10T. It uses trending data to calculate the score. And As an example of that, let's say that right now, today, remember, right, I pull my credit report, and right now, today, my credit report shows that the balances on my credit report are very low. They're less than 30% of the available credit limit. So my score, my FICO score, is probably going to be good based just on that information. But my Vantage score may be lower if previously, over the last 24 months, I have carried high balances on those credit cards. Even though today the balances are low, historically I carry a high balance, so it's going to negatively impact my Vantage score. And again, I hope that makes sense. So the thing about the credit scores, as I said towards the beginning of this slide, the FICO 8 credit score is the most widely used score when it comes to credit scoring. The reason for that is the best analogy that I can do is when we're talking about like iPhones, right? So the latest iPhone comes out and you've got, people lined up around the block to get this new iPhone because it's the latest technology. So those are the early adopters. Those are the people who are like, yes, I went in on this hottest, newest, fad. I'm going to take it. And then you've got the rest of us who wait back and go, you know what, I'm going to let everybody else do that first and see what the bugs are and get all the bugs worked out, see how it's working for them. And then maybe I'll go get that new iPhone. The credit scoring works the exact same way because lenders don't know, how will this adjust my bottom line? I might end up making more loans to people who aren't going to be able to make the payments if I adopt a FICO 9 and it ignores that medical debt. Maybe that really is a good predictor. So I'm not going to go with the FICO 9. I'm going to stay with the FICO 8. So even though we hear all this hubbub about the FICO 10, the FICO 10 suite, the reality is for most of us, when it comes to borrowing money, it's not going to make much of a difference because we're not going to find a lot of lenders using this scoring model at this point in time. It's first getting released to the credit reporting agencies. So Equifax, Experian, TransUnion will have the FICO 10 model, so you'll be able to get it if you go directly to them. And then it will be released out to the lenders. And like I said, there will be some adopters, but it's not going to be any full scale, adoption of this new credit model. Okay. So when it comes to credit, I mean, there are some things that are the be all end all, when we talk about credit scores and having good credit. And first and foremost is, do we pay our bills on time? I know I've said that a few times today. That is the most important thing, though. When you look at that, and this is really what I'm showing you here, this 35, 30, 15, 10, and 10 is a FICO model. But you can really apply this all the way across any type of credit score model that you want to look at. They're all, payment history is going to be the most important. No 30, 60, 90 days late. We don't want to see collections, things like that. And the farther you get away from those things, the less of a negative impact they have on your credit. So that's always a good thing. Time is your friend when it comes to credit. And 30% is the amount that we owe. So how much do we owe in relation to how much our credit limit is really what that is evaluating. So if my credit limit is $1,000 and I'm using, $1,000 of that, I'm using 100% of my available credit limit, and that is going to hurt me substantially in my credit score. So I want to keep that debt very, very low as possible. Again, the rule is 30% or less of the available credit limit. But as low as you can is the better. Now, what do I think right now? I think a lot of people are going to try to bridge gaps using credit because that's the reality of it. Most of us don't have huge amount of savings. What have we been talking about for the last couple of years? How most Americans don't have $400 to make it through an emergency. And now here we are, we're in an emergency and people are going to have to bridge this gap somehow. Whether it's through social service agencies or credit lines of credit cards, whatever it happens to be. So reality and what's best for your credit might not match at this point in time is really what I'm trying to say, but the idea is to understand it. and to try to help people to minimize what they have to do or minimize the amount of credit they use to make it through this kind of a situation, and do the best that they can to come out the other side, without too much to have to clean up. Um, the other thing I want to talk about, just because it's one of the things that people struggle with or have a lot of questions about typically, is when we talk about closing cards, that 15% people get hung up there, how long you've been using credit, and they go, well, so-and-so told me not to close my account because it's my oldest account. And I'm not saying that's not necessarily accurate, but the thing that's more important when you're talking about closing accounts is thinking about what does that do, like credit cards, what does that do to my available credit limit ratio? So for instance, if I have 2 credit cards, and now I wish I had a visual here, but if I had 2 credit cards and each one of those cards had $1,000 credit limit and one of those cards was maxed out, right now I'm using 50% of my available credit limit. If I close the card that doesn't have anything on it, then I immediately jump up to using 100% of my available credit limit. So I would not want to close that card right now if my whole purpose was to try to improve my credit. What I would want to do is work on paying down that card that's maxed out instead. So that's really, I think that's the bigger consideration when it comes to closing credit cards, more so than how long you've been using the cards, as long as you have something that's available. And again, I'm not encouraging anybody to get into debt or to stay in debt or, use credit cards to bridge a gap. But I do understand that, life is life and decisions have to be made. So sometimes that's what happens, debt gets higher. And the idea is to have an idea of how will you be able to work your way out of this and what are the best methods for doing that, which is about what we're going to talk about right now. Okay. So, when we're talking about finances in times of crisis, the first thing is, hunkering down, organizing what you've got and assessing, where am I? What do I have in terms of income? Do I have unemployment opportunities? Do I have employment? Do I have savings? Do I have side work? Is there some other way for me to increase my money at this point in time? Which could be through, like, you're seeing here on your screen, is there substitutions? Is there a food program where I could get food rather than having to pay for food? Are we going to get stimulus money? That could be helpful. Unemployment, to bridge up that gap. Maybe some of your expenses, that middle column, are going to change because you're not commuting to work. So you're not going to have the bus pass fee, or you're not going to have the gas fee, or you're not going to have the parking fee. So expenses might go down. But then you also have your priority expenses, anything that's housing related, medications, the basic food things. What are the things that you have to pay? What are the things that you certainly want to pay? And what's the ramifications of not paying those things? So really evaluating, what, like I just said, what do you have to pay? What do you have to have? What are your needs versus what are the things that you'd like to do and be able to do still, but you might need to reduce for at least the time being. One of the things that we encourage people to do is go back through their spending, whether that's evaluating their bank account, if they can go through their bank statement and look at, where have they been spending money, or maybe they use cash and they're able to save receipts, or they can start, just tracking with a notebook, looking for subscription services. Maybe they have subscription services they don't even realize that they're paying for. Things like, most people realize they're paying for Netflix, but maybe it's a music account or an ancestry account, or something like that, that if they look at that bank statement and they go, oh shoot, yeah, I could get rid of this for now, that will save me $20, or something like that. Is there a substitution? Can I rent some videos from the Red Box versus having the Netflix subscription and save myself a few dollars? So again, really evaluating the income that's coming in. What are the options there? What are the expenses, and is there any leeway within any of those expenses, and figuring out, what is the spending that's occurring at this point in time. And when we talk about this kind of a situation, it's usually, we have two choices. We can either increase our income or decrease our expenses. I feel like we're really in a spot where the main choice is going to be decreasing our expenses right now. There are some things that are hiring. I mean, we've been hearing about that, grocery stores, things like that, Amazon, that could potentially be an opportunity for people to increase income. Is it necessarily realistic? I don't know. Maybe there's things people can do to sell, or maybe they have things they can sell with, as long as they're being, careful about social distancing too. Always things to think about. But anyway, income, expenses, spending, really evaluating those things. Talking to our creditors, a lot of creditors in normal circumstances say, well, there's really nothing we can do for you until you're behind. Right now, creditors are trying to get ahead of the game. Finally, we're seeing that tide turn. So before you get behind, contacting the creditor, making sure you're letting them know, what's going on. What can you do? Can you make a partial payment right now? Or do you need to put all the payments on hold? Right? The student loans right now, you've got 60 days of hiatus. People don't have to make payments on their student loans for 60 days, but they have to call their servicer to ask for that. It's not automatically, except if they're already behind. If they're already at least 31 days behind, then they automatically go into forbearance. They don't have to actually call. I'd probably call anyway, but just so you know. The other thing is making sure that when you're contacting your creditor, you're not contacting them based on them contacting you or sending you an email. We're already seeing scams for people, trying to get people split apart from their money. So make sure when you're talking to your creditors that you're making the call, you're calling the right place, and it's not based, like I said, on them calling you or an email that they have sent you. Keep record of the conversation, the name, the time, any payment arrangements that were made. See if they will send you documentation of the payment arrangements modifications. I mean, they typically will do that, especially in this day and age. They will send you some kind of a notice, email, or a paper copy of the payment arrangements that were made. So it's very good to do. The other thing we talked about a little bit earlier was credit reports. Again, it's a great time to pull a copy of your credit report. You get that record of how you're paying your debts or how a person's paid their debts prior to this situation. And again, it opens an opportunity because you're looking at the credit report to say, hey, put a statement on the credit report that says, I'm going into an economic hardship, because of this, I've been laid off. I'm not going to be able to make my payments. We do now, creditors do have the opportunity to post on our credit reports that they are deferring payments due to a natural disaster. So they can use that designation you see at the bottom of your screen, NDC or DPC, to indicate that you missed a payment due to extenuating circumstances. What that does, so on a credit report, right, if you have a 30 days late, that's immediately going to knock some points off of a credit report, or credit score, I'm sorry. But on if it has one of these codes on it instead, it will not. It basically overlooks. It doesn't include it, and it doesn't exclude it. It just ignores it, basically, that payment. So this being declared a natural disaster has actually opened the door for creditors to use that in credit reporting. So options when it's working with debt, I'm going to have to really hustle here. So working with a creditor, developing your own repayment plan, working through a credit counseling agency, bankruptcy, debt settlements. I mean, there's a lot of different options here. I'm going to flip to the next screen here. When we look, this document actually comes from the Consumer Financial Protection Bureau, and Your Money, Your Goals, excuse me. So this is kind of doing your own thing, your own debt action plan. And you can see, if those of you who are familiar with like Dave Ramsey and the snowball or avalanche methodology, this is really kind of what we're talking about here. So I'm going to give you my little take on it, and then we'll move on here. But when we look at this, I always tell people, here's the first thing is you go through all of your bills, like we were talking about on the income and expenses and, your spending plans here. Go through all of your bills and look at what can you actually afford to be putting out towards, your other types of debts, maybe unsecured debts. Put those in a list. And you can put them in a list in order of, the highest debt to the lowest debt or the highest interest to the lowest interest. Um, and you have an amount based on your budget that you're going to send every single month. So maybe you say, I'm going to send $200 every single month to my creditor. In this example, we have 3 different debts listed. Well, they're not listed, but we have 3 different spots for debts. So 2 of those debts are going to get the minimum payment, and 1 of those debts are going to get the remainder of that $200. So maybe all of them have a $30 minimum payment. So 2 will get $30, and the last one will get, now I just messed up my head, for $130, the remainder of that $200. That last one will, until it's paid off. To get it out, to get yourself out of debt in the least expensive way, you're going to attack the interest first. Some people, though, prefer to go with the debts that have the lowest balance first, because it does give you motivation. As you pay one off, you're like, woohoo, I got one done, I knocked it out. And then you just roll, you keep sending $200 a month, but now you send that, the biggest chunk to the next highest balance or the next highest interest. And I hope that that makes sense to you, how I just explained that super fast. Okay. The other 2 options here, I just wanted to look over really quickly, debt management plan. So a debt management plan is a structured plan through a credit counseling agency. Full disclosure, American Financial Solutions does do debt management plans. So on a debt management plan, the person makes 1 monthly payment to the debt management agency, so the credit counseling agency. The credit counseling agency works with the creditors to reduce the interest on the accounts, stops the fees, brings the accounts back to current if they're behind. The debt management plan typically lasts about 60 months. It can be done much sooner than that, just depending on the person and if they, get an ability to send extra payments, which is a great thing if they can. There are fees associated with debt management plans. There's typically a one-time setup fee and a monthly fee for managing the accounts. I believe for Washington State, that fee is $35 a month. The accounts are paid in full through the plan. The creditor is on board with the plan. That's part of the creditor has to agree to the plan, which is part of that working with the credit counseling agency. The benefit of working with the credit counseling agency is to have that happen. So you're not left, getting late fees or with debt that's not getting paid. So it is a very positive option for people who need help moving their debt forward, and they're just kind of stuck making minimum payments and they're not getting anywhere. Debt settlement is a very different animal. So in a debt settlement, the creditor is going to end up being paid less than what they owe. That's what it will show on the credit report, that it is a debt settlement. So it was settled for less than agreed. If you use a debt settlement company, which I certainly do not recommend anybody do, there will be additional fees to that. And the thing is that if you're going to settle a debt, you can settle the debt on your own. You don't need to use a company to do it. You can see I kind of outlined how the fees work. So if someone owes $10,000 and the debt settlement company is able to get that knocked down to $5,000, the debt settlement fee is based on the amount they got knocked off. So 5,000 times 0.25%, 1250 is what their fee is going to be. For clients, this means that anything over $600 that is forgiven in debt is considered unearned taxable income. So they may have to pay taxes on the amount of debt that they did not pay, which is not necessarily a good thing. So that's a big distinction there. That again, and the thing about debt settlements is that you have to get behind. You have to be behind in order for a creditor to really feel like it's in their best interest to try to do a debt settlement with you. If you're current on your accounts, you're going to end up getting behind. I mean, like I said, you're going to be behind. It's going to be very damaging for a credit score, and it's really a negative situation. In a debt management plan, a credit score can drop as someone initially joins a debt management plan because their accounts are closed. But the idea is that making those on-time, consistent payments and reducing the debt does increase that credit score over time. And we see that a lot. That's a lot of the feedback that we get from people, which is really good to know. Okay, bankruptcy. So I'm not going to talk a lot about bankruptcy because I'm not an attorney, but just in general, in a Chapter 7 bankruptcy, basically, if you have things that are not exempt by law, you may have to sell those things or have a trustee sell those things in order to raise money to pay some of your debts. If you don't have anything like that, which many people don't when they do a Chapter 7, then you can be, your debts can be resolved without having to make any payments. So the difference really between a Chapter 7 and a Chapter 13 is that in a Chapter 13, you are making payments towards paying down your debts. And there are things in a Chapter 13 that can be included in that repayment plan that you could not include in an actual Chapter 7 bankruptcy, and it'll stop it. Like sometimes we have people who, in order to get their driver's licenses back, they will go into a Chapter 13 to get that debt put in a repayment plan. So they're making payments to the collection agency and they can get their driver's license back while they're doing that. That's not a perfect reason for doing a Chapter 13, but again, it's an opportunity. Sometimes people will do that because they're being garnished, and it'll stop that garnishment, illegal garnishment, and they'll have to make payments through the Chapter 13 during that period of time too. There's a lot of ins and outs to bankruptcy, and like I said, that it's definitely something that you should talk to an attorney about. But just understand some things will not go away. Child support, alimony, student loans. There are some exceptions to student loans. Taxes, things based on fraud, wrongful death lawsuits. Those are things that don't go away. They might be able to be included in a payment plan, but they will still survive after a bankruptcy. But a bankruptcy can be a great option for someone who is just simply overwhelmed by their debt, and it's mostly unsecured debt, and they need a chance to start over. And then now this is a very complicated looking slide. This is really dealing with debt collections. This comes from the Credit Builders Alliance, dealing with collections debt, all about negotiating with creditors, collection agencies. So if somebody is going to try to do a debt settlement, this is really the strategy they can use on their own to do that, or even with someone to try to help them, walk them through this process. But the first thing is, just like we were talking about earlier, listing out the debts. Who do I owe? How much do I owe? How old is this debt? That's very critical when it comes to collections debt. And I'm not going to go super down this bunny trail right now because we're running out of time. But so figuring out the debt, starting with the newest debt and priority debt. So like if someone has debts for an eviction, high priority debt, because that's a debt that could make it so they cannot get into anywhere else to rent a house or an apartment. So that's something that you would want to take care of. Legal fees, child support, alimony, those kinds of things are also high priority debts that you want to take care of and not kind of put off until later. So the idea behind this is, again, it's prioritizing the bills, prioritizing the debts, thinking about what's most important to pay, thinking about what you actually have to pay, and then working with the collection agency, in a manner of speaking, letting them know, hey, I have this amount of money. Will you take this and we'll call the debt even? So I have $500, my debt's $1,000. Will you take this $500 and call it a day? And this does give you some negotiation tactics for dealing with those collection agencies as well, which is very important, and things to say and things not to say. The more important that you make it seem like your credit is to you at that point in time when you're talking to a collection agency, the more leverage they have, not the more leverage you have. So you're just trying to take care of some debts, not that big of a deal. I mean, that's the kind of the gist that you want to put out there, if you're talking to a collection agency. Okay, I know. Credit building strategies. So this is the link Alice sent out earlier this morning. This is in that document that she sent out. And there's a lot of different strategies in here to build credit, rebuild credit. And I just want to say that, you know, one of the number one things we refer people to do to build credit and rebuild credit is using secured credit cards through their credit union or a bank, where they put down maybe $300 to $500 at that credit union or that bank as a deposit, and the bank or the credit union issues them a credit card, a secured credit card. So they're not using the funds that they used as a deposit, but it is a credit card and you use it just like a credit card. So when I'm talking to people about credit building, you know, you keep a low balance. You don't keep a balance. I'm sorry, that's not what I meant to say, but you don't, so you use very little of the card. So maybe you use it for something that is already part of your normal monthly budget. So maybe you pay for your Netflix account with this secured card, and then you just use your cash to pay off the card. And that's a great way to build credit, establish credit. It's getting reported to the credit reporting agencies, typically 12 to 18 months after the person has started this endeavor with a secured card. The bank or the credit union will either issue a refund of that money. So they'll get the money back, that's a deposit, and they'll increase the credit line above what it was originally, or convert that card to an unsecured card, have the person apply for a new actual regular unsecured card. I'm going to skip over the share secured loan. Authorized user is a method for people to be able to add positive information to their credit report without having their own credit account. So if let's say that I have great credit, or let's say Alice has great credit and I don't. If Alice authorizes me on her credit card is going to show up on my credit report. And that's the only thing from my credit report, on my credit report from her credit report, and nothing from mine is going to hers. The thing we want to be careful of, though, is if that credit card company sends me a card, then Alice wants to have that card, not me. Don't let me have that card, because if I run that account up, I am the one who's responsible. I am not the one, Alice is the one who's responsible for repaying that debt. It's not going to fall to me because I'm only an authorized user. In a co-signing situation, it would be the opposite. We would both be equally responsible for repaying that debt. The account would show up on both of our credit reports. And again, there's equal responsibility, both of our credit reports, but ultimately, if I didn't pay that bill on a co-signing situation, Alice would be the one who is responsible for that. And the last thing I want to touch on there is the alternative credit history. That is something that we see some success with. People generating an alternative credit history based on the bills that they do pay that don't normally show up in our credit report. So that could be their rent, their electric, their cell phone, their cable, vet bills. I mean, who knows, whatever it is, if they're making payments on it consistently and they have a history, that's something they can collect together to create an alternative credit history. And like I said, we've seen success for that for people seeking to rent a house or an apartment. And we use that sometimes in our housing department as well. So it is a great opportunity, and there's a lot more information about that in that Apply It Building My Credit handout from the FDIC, the Money Smart handout. We have 2 minutes left. I'm going to let you look at this last slide. Alice, do we have any questions?
Becky, we do have 2 questions,
Okay.
and I'll go ahead and read them. The first one is, thoughts on why contacting the credit bureau rather than the creditor is preferred. My understanding of the Federal Credit Reporting Act is that requests starting with either party has the same 30 days to investigate and respond. The creditor may have more of an incentive to maintain customer relationship and may have more flexibility to negotiate if the information was reported was correct, but the consumer would like to find a workout.
I would say, and I'm not ever saying that people should not go directly to the creditor themselves. We see more success when we have people go directly to the credit bureau to make that dispute with the creditor. And I would say that's, really, that's 20 years of experience saying go directly to the bureau to start that. I think we've seen a huge turnaround in the responses since we had, since New York actually sued the credit bureaus themselves because of the disputing errors and the disputing issues that were occurring. So I think that it has come a long way, but I think that that's really where that comes from, is that just experience and understanding.
So Becky, we have another question, but don't you have tax implications when you don't pay the full amount?
Yes, that's what I was saying in there. So if you don't pay the full amount, you do have anything that is over $600 left on the table is going to be considered unearned taxable income.
So we're at the top of the hour.
Yes.
And I wanted to thank American Financial Solutions, Becky House, for taking time today to be with us. As you can see, AFS, American Financial Solutions, they do financial education, credit counseling, debt management, pre and post bankruptcy counseling and debtor education. They also, and I think this is important to note, they do pre-purchase housing counseling as well as foreclosure intervention and assistance. They also do student loan counseling as well. They're a USDA 502 single family direct loan provider and a USDA Section 504 repairs and loans and grants. So once again, I want to thank everyone. Becky will be joining us in April for our workshop, an overview of financial empowerment. That will be on Wednesday, April 22nd. During that workshop, we're going to look at an overview of financial empowerment and the resources that are available uh, to look at the benefit of a cash flow budget for reducing expenses and insisting in income preservation. So we'll go into a little bit more detail on the income preservation. Again, thank you everybody for joining us, and we look forward. There are a few more questions and answers that I will include and have Becky address in our follow-up email. Again, this email or this webinar is being recorded, and an email will be sent with the link to provide the recording. So again, thank you so much, everyone. This ends our webinar for today.